This is the current federal tax developments for the week of May the 19th, 2025. Current federal tax developments are brought to you by your state society of CPAs. At Zollers, I'm speaking again this week from here in Phoenix. And important to note that I'm recording this on Friday afternoon, just after noon here in Phoenix. And at this point in time, which will become important because we're going to discuss a couple of issues related to it, uh, the House Budget Committee has just basically failed to advance the reconciliation package. So we'll have a brief discussion about what that means and how the status could change by the time you're listening to this. But we're still going to talk about what's in the proposed package. Presumably, assuming we get any sort of tax bill through this year, which, we'll have to see how things work out right now. But in theory, it would look like they're going to try to do something, even though they have a little bit of a setback right now. We'll see how big that setback is over the next few weeks, because it's going to take some time to figure out how this goes. But we will talk about that, because if we get the bills, it seems very likely that provisions like this will be in the bill. So we'll talk a bit about that. So what are we going to talk about this week? Well, we're going to have our topics this week. We're going to talk about a couple of cases on Section 7433. It's like, oh, good, we have a topic this week. The first case we'll talk about 7433 and the fact that if you're going to sue the federal government, and 7433 is a provision that allows you to sue the federal government for damages in certain cases, you have to have a grant of basically a waiver of sovereign immunity. You can't sue the sovereign, right? The king, unless the king gives you permission to do so. So this is where we're going to talk about what criteria you must meet to sue under 7433. And we're going to have basically two cases where they don't quite meet that criteria. So we'll talk about that here. So that the second case we'll talk about between our two 7043 cases will be a case looking at the claim of right doctrine and applying that to business errors. We'll talk about what the claim of right doctrine is. I'm sure some of you have run into it before. And you have to recognize what it is and isn't. And in fact, in this case, we're going to have both an is and isn't situation in play. So we'll talk about that and how it works. Next, we're going to move on to a couple of provisions from the One Big Beautiful Bill, which now is in a One Big Beautiful stall as I basically record this. But we'll talk about two provisions that affect essentially pass-through businesses. We'll talk about the proposed changes to 199 Cap A under the bill that the Ways and Means Committee did kick forward. And now it's failed in the Budget Committee temporarily, or maybe permanently. We'll see that later. And then also proposed changes that affect the pass-through entity tax. Basically, the state level pass-through entity tax, there'll be federal changes that will make it either less valuable for your clients or eliminate it entirely if your clients happen to be a specified service, trade, or business. We'll talk about that, including the fact that just about an hour before I started recording this, I got an email from the AICPA now that realizes this is there and is trying to get CPAs to call their congressperson and their senators and essentially, tell them, no, don't do this. Because, of course, gang, if you are organized as a pass-through entity, especially as a partnership, where you get potentially the biggest benefit of the pass-through entity tax, because all of your income comes out and is subject to the computation of the, or I shouldn't say not all your income comes out, but all your income is coming through the partnership. Therefore, your state tax is on all of that income that relates to the partnership. That's probably the biggest bang for the buck for a pass-through entity tax, and why that may not work for you, or wouldn't work for you after 25 if the bill passed as is. We'll talk a bit about that. And finally, we're going to talk about a taxpayer that got involved in a tax shelter. There is a somewhat odd back and forth on an opinion letter they got to back up this shelter. In any event, it was a shelter that very clearly was giving deductions way beyond any money that was actually at risk. And needless to say, the IRS wasn't thrilled with the concept. And it turns out neither was the court. So we'll talk a little bit about that. So let's take our first case this week when somebody's trying to sue the federal government for damages. This is a case of Manuel Lampon Paz versus United States of America. This is a case from the U.S. District Court in the state of New Jersey. The opinion came down on May the 6th of 2025. It is case number 23 CV 02248. Talk about this little background. Now, this is a key about the interpretation of a phrase, which become important in both cases, of what's in connection with collection of any federal tax under 7433. And the key takeaway from this section is going to be that section 7433 waiver of immunity, where you can sue the IRS for certain, let's say misdeeds, is going to be very narrowly interpreted. And it only applies to IRS's affirmative steps to collect taxes. That's, in essence, doing things wrong or with bad faith in the effort to collect taxes, which is not the only thing the IRS does. And that's probably the key thing we need to worry about here, is that it's not everything the IRS does not actually fall into that category of being something looked at for the collection of taxes. You might think so, right? Isn't their ultimate point to get the taxes? Well, yes and no. And so we'll talk a little bit about that yes and no, how it works, but what's actually going on there. And we'll at least give you some background about how all of this will end up working. So we'll talk about that. Let's go ahead and talk about some of the background here and what exactly, Manuel was alleging the IRS did wrong. Now, the plaintiff, Manuel upon Paz, had filed a lawsuit representing himself, and he was seeking damages under Section 7433 of the Internal Revenue Code. Now, he claims the IRS, misbehaved following receipt of a CP11 notice about taxes owed due to an IRS return correction. The IRS had corrected his return, what he had filed. And we see those things come out all the time, right? The IRS files a correction. They claim something was wrong on the return. Well, he got that. He said the following things happened, all of which he believes gives him a right to sue the IRS for damages under 7433. First issue was an IRS employee provided him incorrect information, and he said willful false statements on a helpline call, and that deprived him of the opportunity to challenge the assessment. The IRS ignored his attempt to request a hearing to dispute the assessment. The IRS did not mail necessary notices of intent to levy before collecting his taxes. And the IRS made material false statements and withheld evidence in prior and current litigation. Sounds bad. Yeah, these aren't good things. Well, the problem is, as Manuel is going to discover, 7433 is somewhat limited. And this is going to be one of his issues. And the court notes that the first question it's got to answer is, does it even have jurisdiction in this case? Because if the government has not waived its right to be sued in this situation, then the district court has no jurisdiction to take up the case. There is no relief they could offer. Let's talk about what we got here. As noted, the federal government and all of its agencies are shielded from suit by the concept of sovereign immunity. Goes back to English common law, the idea that you cannot sue the king unless the king gives you, basically permission to sue the king. And the king is not just the king himself, but also all of the government, that operates under his control. That was the concept of the immunity of the sovereign immunity. So Section 7433 provides a limited waiver for certain civil actions for damages against the United States government. Bingo. Well, that's good so far. Now, 7433 essentially, has, it must be in connection with any collection of federal tax. And they note, we must strictly construe this in favor of the sovereign. If the allegations are outside 7433 scope, then the court lacks jurisdiction. So either Manuel would need to find another provision that allowed him to sue for whatever the government did, or he might just be out of luck. Now, 7433A permits a civil action for damages against the United States if an IRS officer or employee recklessly, intentionally, or by reason of negligence disregards any provision of the IRC or regulations promulgated under that section that is in connection with any collection of federal tax with respect to a taxpayer. So this is where, if all of those are true, then a taxpayer is allowed to sue the federal government for damages. Right? Now, this civil action is the exclusive remedy for recovering damages from such actions, except for actions for failure to release a lien under 7432. That's the issue we're looking. So basically, if this has happened, this is the way you have to go about collecting it. Well, the court began looking at his various claims to see whether or not it was actually bringing up an issue that would bring 7433 in. Now, his first claim was that he got incorrect information from an IRS employee on the helpline call. What happened was he called the IRS on one of those 800 numbers on the notice to challenge his assessment after receiving the notice. Now, the court agreed with the IRS that this was not an affirmative step by the IRS to recover money, right? The problem is collection of federal tax implies affirmative collection steps. In this case, Manuel was calling the line. It wasn't that the IRS reached out to Manuel in an attempt to get the money from him. Rather, he was calling a helpline, generic helpline. And so, citing Agility Network Services and the Robertson case, the court found that explaining how to respond to a notice or denying a refund request is not a collection activity. And it's a refund request because to keep them from, trying to collect other ways, he had paid the tax. He's now looking to try to get the money back. And again, so bottom line, that they said, well, denying a refund request isn't collecting. They already have the money. And, explaining how to respond to a notice is not a collection activity. It's just giving you information about how to move forward. So they said this claim did not give the court any jurisdiction. Even if they had given him misleading information, did all of that stuff, it wasn't with regard to collection activity. Therefore, 7433 could not be used to sue them. Well, claim number 2, he said they withheld evidence and they made a false statements to him in regard to litigation, right? Right? This allegation concerned conduct in a prior trial initiated by Manuel and the current case that he was involved with. So we had a couple of cases involving issues regarding this tax. Now, again, the court went back to its first line. Since the IRS did not initiate these actions, they weren't IRS-initiated collection actions. They're not covered by the 7433 waiver. The Section 7433 is also limited to actions by an officer or employee of the Internal Revenue Service. And that wasn't specified by him. They didn't specify which officer or employee basically did the bad thing. For most of his litigation allegations, he just said the IRS, right? So they said, again, based on what's in front of him, they have no jurisdiction under 7433. Again, this was not a collection activity of the IRS. Simply failed that. Now, the third claim was the claim that the IRS had failed to provide notice to him of his intent to levy. Right? He said they alleged to provide that notice before the levy. And the IRS conceded that a failure to provide a required notice might subject them to a 7433, claim, right? This type of failure is covered. So this, at the moment, is at least a claim of the sort that would get you in the door to get damages from the IRS for the fact that they had, misbehaved on a collection activity and you'd incurred damages. But the IRS said those notices were sent, and that his claim that they were forged, that their records of them were forged, that was covered in a prior case. Now, what this means is, which is somewhat important, is because it had been an issue before, this hinges on a theory called collateral estoppel. Collateral estoppel is a legal theory, issue preclusion, which bars relitigating. The whole point of this is we don't want to have people go to different forums and effectively keep relitigating the same issue, right? If you've had a full chance to litigate the question and the court's decided this answer, then, and appeals are exhausted, we're done, or you didn't appeal, whatever, appeals are exhausted, then we're done. That's going to be the finding of any other court you end up with on that issue. Now, this works if 4 criteria are met. This is an identical issue was decided in a prior adjudication before a court. That's case 1. There was a final judgment on the merits of that. That is final, no longer subject to appeal, right? We're done. It was a final adjudication. The party against whom the bar is asserted, in this case Manuel, was a party to that prior case, and the party against whom this bar is asserted had a full and fair opportunity to litigate the issue in question. So the court said that some elements here were clearly satisfied, right? In this case, such as the parties being the same in the prior and current cases. But what the court said might not be the case is whether the identical issue, the forgery claim regarding the notices the IRS had forged documents, was definitely decided in the prior adjudication. The prior ruling stated the notices for 2015 and 16 were mailed on February 11, 2019. But the court didn't know if that was a decision fully at odds with his claim, which is that there was a forgery involved, right? This is the same. They said, it might not be the same issue, so we need more information. Because of that, the court decided that the defendant's motion, in this case the IRS, to dismiss this claim was denied without prejudice. In essence, they could renew it later, move forward if in fact they're saying, look, there's not been a showing now that in fact, there's not been evidence produced yet that there was a true forgery, or they can show additional evidence to show that the prior case really did fundamentally decide this issue. So basically, this one is still in play, but to be decided later. So overall, the IRS's motion to dismiss was granted in part. The first 2 claims were thrown out, right? And the third one was denied in part without prejudice. That is claim 3. They would have to be further briefings and further arguments regarding collateral estoppel to clarify if the forgery issue had truly already been resolved. If it had already been resolved, then Manuel's out of luck. He's not going to be able to get anywhere with this case. Now, let's talk about the takeaways from this. One key issue is if you're going to come into this, you have to make sure, remember, if your client is looking and this, when you're going to, they're thinking, I should go to an attorney. I should be able to sue the IRS for this. You have to remember there has to be a clear statute that allows them to do it. And 7433, clients are going to read that. I understand. They think, well, they got money from me. So this was part of collection, but that's not the way the courts read this. It only applies to actions in connection with tax collection, right? It does not cover any error in an assessment of a tax or in determining the tax liability. Those you have to go through other mechanisms, right, to handle, but it doesn't do that. This is a collection-only statute. It was meant to handle abuses in collection. And what is collection is very narrowly defined. The courts interpret collections as being the IRS's affirmative steps to collect taxes. Calls on a helpline, denying a refund claim, or litigation context when it's not an IRS collection suit generally are never going to be collection failures, right? You're not going to get in the case that way. And finally, direct failures related to specific collection procedures, like required levy notices, that could give rise to a Section 7433 claim, because now that was the one area, the levy system, that was an IRS action to collect the tax. So now we were at least the right place, but in this case, we don't know that it did because additional facts had to be done because it may have already been decided by a court. The key thing here is remember, If it's a jurisdictional issue, if the alleged actions weren't in connection with collections, then essentially the court will lack subject matter jurisdiction. Doesn't have, sovereign immunity has not been waived. The court can't step in and enter a judgment against the IRS or the government without that waiver. And also conceptually be aware, and clients have to be aware, if in fact the issue has already been decided, collateral estoppel will keep you from going at it again, right? And that was true even if you say, well, I didn't agree with that, but it didn't make sense monetarily to take them to the Ninth Circuit or whatever your Court of Appeals is. That's great, but the problem is you now have collateral estoppel on this issue. And even if there is an action you can still bring on something else, in this case you could, if the IRS filed upon collections, that could be separate and apart from the issue that the court had looked at, in the other case. But you got to be able to show that it was never actually adjudicated by the other court. Anything the other court has already adjudicated, you're going to be stuck with that result because you didn't appeal. You didn't keep trying to push it and get it overturned. And you got to understand how narrow this is. I mean, 7433, a lot of clients will read about it because, they're saying, Congress stepped in. They were going to, punish the IRS for bad collection activities, et cetera, for being bad people. They didn't really just do that generally. And it's not that everything is collection, which is part of the issue. Okay, let's talk about the claim of right doctrine now. This is the case of Norwich Commercial Group versus Commissioner. The tax court memorandum decision 2025-43 that was issued on May the 12th. Okay. Now, this case looks at the application of the claim of right doctrine. The funds were received by an accrual taxpayer due to mutual business errors. They kind of fouled this up for a while. And the timing of a related deduction, because what's going to happen in this case is Norwich Commercial is going to end up with money they shouldn't have. And eventually, it'll be discovered and they'll have to pay that back. And we will get into the issue because they're actually 2 times end up with money that they shouldn't have had. And we'll discover why in one case, the court found that claim of right worked. In the other case, it was simply an error. And because the statute was closed on the year in question, it was tough luck. They just overpaid their tax. Now, this doctrine of claim of right depends on whether funds were received under an apparent right without restriction, lacking a consensual recognition of the obligation to repay at the time of receipt. So you got money, you believed you had no restriction on it, and it wasn't like a loan from the bank. Yes, I can go to Bank of America, and get money off a credit line, and I can spend that for what I want pretty much. Let's say the business does, we can spend it for whatever we wanted to in the business. But we basically have agreed to repay it. But, in this case, we got the money. We didn't think that we would ever need to repay the money, and, we had no reason to believe it, right? The timing for accrual taxpayers is tied to economic performance for the repayment. So we'll get into that. So what's our facts in this case? Well, Norwich was a mortgage loan originator, and they use warehouse lines of credit from banks like Liberty Bank. Liberty Bank comes into play in this case, right? We'll also have a Farmington Bank that comes into play later. So we'll talk a little bit about both. Now, they use separate clearing and operating accounts at Liberty. Fee income was swept from the clearing account to the operating account, which was controlled by Norwich. It was a clearing account where the funds went in and out. The Liberty would then essentially keep the funds. That should be going back to them to pay back the line of credit. And the amount that represented fees would end up moving to the operating account, which was controlled by Norwich. Now, due to inaccurate statements by Liberty, the lender, and internal errors, duplicate advances, failed paydown, the Liberty line of credit became severely under-collateralized, right? Liberty didn't realize that, Norwich owed them money because Norwich had received amounts that really were loans that got put into their operating account. And of course, they didn't know they were loans. Well, now they are way fouled up. the bank has discovered they're way fouled up because they are way under the amount of collateral they should have had to have a loan of this size. That's bad news for a bank, especially the bank examiners are in the building. Yeah, you don't like discovering things like that in that case. Right? Now, both Liberty and Norwich is our taxpayer here, Liberty is the lender, they both mistakenly believe the money being put into the operating account only represented earned fee income. And because of that, not only did Norwich keep the money, but they reported that as income on their tax returns from 2007 through 2013. Now, as you might guess, you filed returns for that many years over-reporting income, yeah, your statute's going to be closed on some of those years. So, okay. Now, these errors weren't discovered until 2014. And Liberty and Norwich agreed there was a net over advance amount of approximately $6.7 million. Not a minor amount of money. Now, Norwich agreed to provide additional collateral, security interest and assets, and reduce the line of credit balance. And they made payments in 2014 and 2015 to accomplish this. Right? And Farmington bank errors were also found. They somehow misdirected proceeds that should have went to Farmington to Liberty. That totaled $383,728 in 2014. They repaid that amount in 2012. They repaid that amount in 2014. Farmington hadn't been aware of this. They hadn't been aware the money had, that the money had come in, right? They had just, basically Norwich had screwed up and put the funds into the Liberty account. So, that's a key distinction here because Farmington wasn't aware and had no way of being aware that there was $383,000 they should have their hands on. And they did. Okay. Now, the key dispute was whether the amounts paid or collected to both Liberty and Farmington, and the two are going to get different answers. So we'll talk about that in a second. Loan repayments, they were not income when received, so therefore not deductible when repaid. If they were truly loans, then that's how they should be. In which case, then tough luck. Norwich is out of luck. Where the deductible amounts rising from income previously included under a claim of right. Remember, Norwich has included this money in income in both cases. So both cases, they've reported the excess as income. Now, to have a claim of right doctrine, we're going to talk about why this is important because this is what sets up our deduction. You had to have receipt of funds, control over disposition of the funds, right? An assertion that you were entitled to the funds, you believed you were, and a lack of a consensual recognition of an obligation to repay at the time of receipt. Now, taxpayers said they overreported income due to 2007 to 2013 due to errors. The claim of right doctrine entitled them to a deduction in 2014, the discovery and obligation year, or alternatively 2014 and 2015, the repayment years. They said that deduction was an ordinary business expense under 162 or a loss under 165. They had some alternatives there. Now, the IRS position said, wait, these funds were loans. They always were loans. It was not income when received. I mean, I'm sorry, Norwich, that you reported it that way. You're bad. But basically it was an income, right? They're saying the claim of right didn't apply in that case, right? It was basically that it. Implicit consensual recognition of repayment existed, right? Under the agreement, this had to be repaid. There was no question. They may be fouling up, in essence, and there was a foul up in both cases. There's no question, both Farmington and Liberty. But that was it, because there was implicit obligation. They had to repay whatever they weren't allowed to keep. And they said alternative, if it was deductible, the deduction was limited to economic performance. That is only the amount you repaid each year, not when you discovered you really need to repay the whole thing. You couldn't just accrue that up, even being an accrual basis taxpayer in this case. Now, the errors for Liberty. Let's talk about the Liberty errors first. Now, the court found that both Liberty and Norwich operated under the assumption that Norwich was entitled to the funds. They had the funds swept into their account, right? So they thought it was there. The use of the funds in the operation showed that they had to believe. Norwich believed that they were earned revenues. So they had the belief necessary. Their mutual unawareness of errors, this is going to become important, right? Of the errors, duplicate advances until 2014 means there was no implicit obligation or consensual recognition of the obligation to repay, and these specific erroneously transferred funds, at the time of receipt. The conclusion: the inclusion of the erroneous liberty transfer, remember, both parties were involved in this, from 2007 to 2013 was in accordance with the claim of right doctrine. Therefore, the proper remedy was a downward adjustment to 2012 income, not a later claim of right adjustment, deduction, right? Or that, well, we'll get that later. We'll go with this. It really shouldn't be there. Got that double counted. Okay. Right. Sorry about that. That last line, yeah, not there. That's actually what we're going to get to on the other one. So ignoring that little line on there, the actual first conclusion on that line, I was putting things in to split over 2 slides, and I accidentally deleted everything except the bottom part. So that's how we get in there. It's like, yeah, you got to watch when you edit. In any way, so the erroneous inclusion of liberty transfers was a claim of right doctrine, right? It qualified for that. Now, the Farmington errors were different. The Farmington proceeds were just mistakenly deducted into the Liberty account, right? By Norwich. It was Norwich's error. Farmington didn't put it there. Remember, basically on Liberty, it went into the first account. Liberty would take out the loan, leave the fees, or take out the loan amount, transfer that to their account. Then the fees they would transfer to the operating account. Liberty had mistakenly failed to fully repay the loans and had transferred that stuff they hadn't properly caught that it was a loan that should have been repaid, and was transferring that into the account that Norwich reasonably believed represented their fees. I mean, the bank was not supposed to put non-fee income in there. Okay. Both parties agreed this was improperly included in the 2012 income, right? The IRS and the taxpayer did. And they said there, this is where he said, in this case, a downward adjustment for 2012 income is what was required, not a claim of right. There was not a mutual error. This is just Norwich had the information. They were solely responsible for screwing this up. And because of that, they can't fall behind. Farmington, had they been aware the money was there, would have said, hey, you owe this back to us, right? Yeah, that's the money and not income. They just messed up and confused what they got as payment. They couldn't use claim of right because in this case, the bank wasn't involved in the error. So the payments and collateral to Liberty were deductible. Providing collateral and paying down the line of credit was necessary to remain in business using the Liberty line of credit. It qualified as a deduction, and they didn't really care under which one. The courts said either 160 or 165. We're not going to split hairs there. It's an ordinary deduction either way. Now, the deduction timing for accrual taxpayers does depend on when the liability is fixed, requiring economic performance. It found the economic performance occurred when Norwich was required to immediately provide property by restoring collateral. November 2014 agreement granted security interest constituted providing that property, and that was the trigger for the deduction date. Right? Now, like we say, talk about this in timing, right? We get in that realm. Under Regulation 1.1341-1E, 1341 is the claim of right section. This regulation titles it, the claim of right deduction accrues when the obligation to restore is secured with cash or collateral. Either way, paying it over or putting up collateral was enough to satisfy the obligation and go there. It was accrued, and economic performance occurred in 2014. When the agreement was signed, collateral was given. They'd agreed upon and fixed liability at that point. That deduction was taken in 2014. Now, deduction amount is limited to the prior year over-reporting related solely to Liberty's mutual errors with the taxpayer. So Liberty over-reporting 2007-2014 was $7,275,689. The amount related to the 2014 error was $321,572. That was corrected in 14, right? That much because they discovered it that year, they properly reported it. The deductible amount was essentially the difference in those two. Claim right deduction would be $6,954,117. right? We discovered the error in 14, therefore we corrected that and figured that we now knew that that was a debt, or basically what was something we owed for back. But the earlier years we're stuck with. This goes, and the reason why we have this is it goes to the concept, which you'll also see the Supreme Court mentioned in a few tax cases from time to time, that we have an annual tax system. And our tax has to be based on things that were known or knowable at the end of the tax year. Right? It wasn't known or knowable that this was a debt at the end of the tax year. So those prior returns under the claim of right theory are proper because, we had this issue where Norwich, had treated them as, essentially income because, the bank had given them the money in the account that appeared to be income. Now, as I said, Farmington, not the same thing, therefore not the same result. So let's talk about quickly the claim of right. This applies when income is received under the parent right without restriction, and most importantly, without anybody recognized we had to repay it at the time of receipt. A mutual mistake of fact can negate this consensual recognition, right? Basically, they were liable for that debt immediately. It always was the case that if you figured out the facts, they had to repay it. There's no question. They had to repay it. Norwich had to repay those funds. But the fact that they and the bank had a mutual mistake of fact because Norwich assumed they would only get money into that account if, it represented fees, and the bank believed they had only put fees in that account. That was where the issue is. Now, errors leading to income overpayment might require amending the original return if they don't meet the claim of right criteria. Right? In the other case, our problem was it was the taxpayer's only mistake. They made the mistake. They put the money in the wrong account and didn't notice it was Farmington funds, right, that came back over, and they poured that as income. It was their error. It was not Farmington. Farmington had nothing to do with this error, right? For accrual basis taxpayers, the claim of right deduction timing is governed by economic performance rules. You can go look at more detail at 461H for those rules. And as this said, providing collateral to secure repayment obligations can establish an economic performance for an accrual basis taxpayer, accelerate the timing of the claim of right deduction for an accrual basis taxpayer. And determining if funds were received under claim of right is a careful, very detailed, fact-specific analysis of the circumstances at the time of receipt of the funds. In essence, did they believe they had a right to keep the funds? Or did they believe that essentially that they were going to have to repay them at that date? That would be important. Now, the one thing not really covered here, I'll mention briefly in claim of right. Generally, if the claim of right amount is above $3,000, you do have the option to rather go for an election to claim it as a credit equal to the excess taxes reported in the prior years. That would primarily be useful if your tax brackets had gone down. So currently, we wouldn't get nearly the tax benefit from the deduction by reducing this year's income that we would if we had gone back and, essentially never misreported. Now, in this case, they decided to do that. They decided to take it this year, which likely means either, we were looking at rates that were going to be identical in both years, or even the rates were higher in the year that they were going to repay. That is an issue for claim of right. The other thing I'll also mention is, if you get a claim of right situation, be sure to be very careful and check your state's rules in this area. There are some states that allow you to make the credit or deduction choice. Some states require you to take the deduction if you're taking the credit federally. So you have to take a look at kind of how they handle it. I told you I had a second 7433 case this week. Well, we're going to talk about that. More of this collection versus assessment definition. This is Hannah versus the IRS. This is from the U.S. District Court, Southern District of California, case number 3:24, CV00515. Decision came down on May the 15th. Okay. We're back to 7433, the same sovereign immunity issues that we had here. And we are going to again look at the difference between tax assessment and collection. Again, remember, this is a waiver of sovereign immunity does not apply to assessment activities. Yeah, we had 2 of these this week. right? We did. The plaintiff, again, filing has their own counsel, filed a complaint and later filed a first amended complaint. Now, he was granted leave to proceed, in essence, in forma pauperis, yes, the legal term there, trigger mandatory court screening. An extension to file the amended complaint was granted on the basis of excusable neglect. Okay, that was kind of the background. Let's go ahead to the procedural activities. So what happened was the taxpayer amended his 2016, 17, and 18 returns as an Uber driver. The IRS processed the 16 and 18 returns and issued refunds. For 2017, the IRS withheld the expected refund and applied it to a new calculated balance resulting from disallowing a deduction. Now, and said, hey, you owe us money. Now, he paid the $1,539 to avoid collection. Remember, we talked about this before? Yeah, that could be a problem. Allegedly, an IRS manager agreed his 2017 amended return was timely, and the expenses and credit should be allowed. Therefore, he really didn't owe that money, and he should have gotten the refund. However, even though he was told that, the IRS rejected a later appeal, a formal appeal of his 2017 amended return decision. So he's now, coming back to court, and he's claiming damages under 7433. They didn't really get into here, why he didn't sue for the refund. My guess is he blew the 2-year statute from date of rejection because he thought he'd already had a concession, and yeah, we see how that goes. Right. Again, same issue, limited jurisdiction. Government's immune from suit. We have the 7433 limited waiver for damages from the United States for disregard of IRC and regulations in connection with the collection of tax. It is strictly related to tax collections. It does not apply to assessment or determination of tax liabilities. These are not an act of collection, and we have the same problem we had before. So it did perform its mandatory screening of his petition under Title 28, the U.S. Code 1915 E2B. And he said the allegations primarily described actions related to the assessment and the determination of his tax liabilities, but not collection activities. Okay? The core complaint was about disallowed deductions and the balance, right? And what he wanted is a refund, right? And, the taxpayer cited IRC sections 161 and 162. Those relate to deductions used in assessing the tax. This was not going to allow him an issue on misbehavior or collection. Right? So even if withholding refunds and applying them involved collections, the basis for the balancing question was a disallowed deduction. That was assessment. So given that we can't challenge the assessment here, the applications were proper, right? They went against the assessed tax. You had to challenge the assessment. And his own statement about paying to avoid collections basically was a bit of his undoing, because you admit you've already paid it over. All your actions were after collection of the tax. The tax had been collected, right? Since the claim challenged the conduct connection with assessment, not collection, there was no waiver of immunity. The IRS might have done bad things, but you're suing under the wrong provision. And realistically, what really should have happened here is he should have challenged the assessment. Now, why he failed to do so, and then why he failed to properly get a claim for refund and challenge, there's lots of problems, lots of issues, but let's just say, yeah, this is a case, again, I understand the amounts involved really weren't big enough to pay for legal counsel, but this is a case where really, I think procedurally he fouled up. And very well could be he should have been paid over, but it didn't happen. Because although jurisdiction was dispositive, he also reviewed whether he stated a plausible claim. A plausible claim regards disregard of law and regulation in connection with tax collections. Collection activities typically involve demands, liens, notices, levities. Assessment is why the tax is owed. Collection is how you get paid. We can't go under anything that worked toward why we owed the tax. You only go after how the IRS went about getting the money once they had assessed the tax. Right? While a notice of balance due could be part of collection, He didn't allege any deficiencies in any collection procedure. Right? They focused entirely on disallowance of deduction, resulting balance. Those are assessment issues. You're attacking the assessment, not how the IRS collected it. If the assessment is proper, then everything they did collect it was fine. So he failed to state a claim under 7433 because allegation did not plausibly describe what was an unauthorized act of collection, not assessment, right? And also, he sued the IRS. You're going to sue under 7433, you have to sue the United States. That may seem like a distinction without a difference. It's not. The IRS was dismissed as an improper defendant. Again, same as before, assessment versus collection. 7433 only works if you're going after damages from collection, right? Disallowed deductions, audit adjustments, calculation errors are assessment issues. You have to, if you're going to go 7433, then you have to be able to find a violation of a law or regulation specific to collection procedures the IRS undertook, right? Challenging the tax liability is not going to work. You always make sure you name the proper defendant. Attorney will usually take care of that. It's helpful to have one, not the IRS. Remember that sovereign immunity waivers are strict. It doesn't matter. It's unfair. It's bad. They were bad. The problem is they have to be bad in a certain way for this to get you in front of the court. That's where our problem comes. There are other mechanisms, and in fact, we all know usually we're working with the assessment side of this, where we have an exam or an IRS challenge, and yeah, there are other procedures you use there, and he failed to use it. If the issue is assessment related, the client should be looking at things like the tax court or paying the tax and filing a refund claim if they want to go to court. If we have to go to court in either case, because we can't get anywhere with the IRS, on exam, we can't get anywhere with appeals, then yeah, you don't want to go here. You want to go through the standard aisles. And like I said, the problem is it's very easy for a taxpayer to essentially lose their right to go to tax court by not paying attention to the 90-day letter. And then, as we've kind of discussed before, if you file a claim for refund and it's denied, you have a 2-year clock running that even if an IRS person told you that, oh yeah, you should get this. Yeah, I totally agree. It should be allowed. Just resubmit it. Not good enough, right? It's going to be there. Okay. Now let's talk about the one big, beautiful bill. Okay. Going to talk about this. Going to have a little bit of information on this. But really, the one big, beautiful bill, we're going to talk about some issues. As I said, today, on Friday, right? On Friday, here, we're sitting on Friday, May the 16th, the House Budget Committee failed to advance the big reconciliation package, which would include all of the tax provisions the House Ways and Means Committee had approved earlier in the week. So we're currently on we don't know what's happening here situation. The reports I have as of right now is they plan to have the various parties meet over the weekend, because the issue right now is in the Budget Committee, 5 Republican House members voted against the bill. And since the Republicans only had a 1-vote majority on the Budget Committee, that's a few too many voting against you. In reality, there were 4 against, and the 5th one changed his vote from yes to no, primarily to enable him to later bring up a motion for reconsideration, right? So they can bring it back before the committee and force another vote. Because this one who voted for it, you have to, under the rules, if you are going to do a motion for reconsideration, old Robert's Rules of Order, etc., you had to have originally voted the other way, right? When you're going to move to reconsider. Somebody who just lost the vote can't move to reconsider. But because of the way the voting procedure works, in essence, this is what makes it ridiculous, and you'll see it quite often in the House and Senate. Once a party knows they're on the losing side and they want to keep it alive, then they will switch to the winning side. They'll switch their vote to the winning side, so they have the right to bring it back to they have a right to bring it back up again. So That's what happens here. Well, let's going to talk about a couple of changes this week. Just want to summarize them in case you haven't heard about them. I want to talk about first what's going to happen to the qualified business income deduction under 199 Cap A, which, as we know, is scheduled to end at the end of this year. What would happen if the provision in this bill became law? And it might or might not. We don't know at this point, but we want to kind of consider it because you need to start thinking about this for clients. And the other catch is we're going to talk about another provision too that will relate to the pass-through entity taxes. So let's talk about an overview of what this thing means and what's going on. So let's talk about the proposed legislation, right? There are going to be significant modifications to the 199 Cap A qualified business income deduction. This will be effective for tax years beginning after December 31st, 2025. This was approved by the House Ways and Means Committee on May the 14th. So we'll get there now. The good news for us under this, assuming if this passes, the good news for our clients who are getting this deduction, is that this would make the deduction, including the special rules for real estate investment trusts and publicly traded partnership income, they'd be made permanent by striking the sunset provision. Previously was set to expire at the end of this year. They would also increase the deduction percentage. Currently, you get 20% of QBI as your deduction. In this case, it would go up to 23%. Right? And it applies to the QBI from operating businesses, right, partnerships, et cetera, you have, but also to the REIT and publicly traded partnership components. So 23% would be the new rate. So far, it sounds good, right? We're good so far, okay? Now, here's where it gets weird. Remember, we have this issue where you have the threshold amount, where you're able to claim, under current law, the full percentage of your qualified business income deduction, right? So the full 20% of your qualified business income, even if regardless of how much you have in W-2 wages or W-2 wages plus, UBIA, right? The unadjusted basis immediately after acquisition, right? That issue, and you get it even if you're a specified service trade or business. Now, under current law through the end of 25, once you get above the threshold amount, we begin phasing out the exclusions. So like for SSTBs, if you're just an SSTB, we're going to slowly reduce you down to zero over $50,000 if you're single or married filing separate, and $100,000 if you are married filing joint. We're going to reduce you down and eventually get you to zero. Okay. Also, during that same time period, we would start phasing in the limitation based on W-2 wages. And if you happen to be an SSTB, right, then, and you don't have sufficient W-2 wages to cover the 20% you're taking, that gets messy, right? It's a messy calculation, which we've all gone through. I remember going over that multiple times after the 2017 bill got passed about how that crazy calculation is going to work. Okay, we're going to change everything now. What we're going to do is once your taxable income goes above the threshold amount, you're going to compute two possible 199 Cap A deductions. And you will get the greater of the two. The first calculation, this only applies to qualified businesses. And what may not immediately click in your mind is under Section 199 Cap A, D1 Cap A, SSTBs are not qualified businesses. Now, under the current law, we ignore that fact below the threshold amount, and then we have this phase up of while we're in there, and then once you get above that, they're simply just not qualified businesses. That means step one will always be zero for a specified service trade or business. Keep that in mind. For each qualified trade or business, the deductible amount, 23% of QBI, is limited to the greater of its W-2 wages or W-2 wages plus 25% of UBIA property. There is no phase-in. The amounts then from these businesses are aggregated. Because the SSTBs are not qualified, basically trades or businesses, they will get zero, will be their contribution to this. Step two, On the second calculation, this applies to all businesses, including SSTBs. You calculate 23% of the aggregate qualified business income from all trades or businesses without regard to the W-2 UBA limitation. So you calculate it just like you would if you're below the threshold amount. However, you will reduce this by a limitation phase-in amount that's equal to 75% of the excess of your taxable income over the threshold amount. So we're going to be slowly phasing it out, right? Or maybe not so slowly. It depends on how you go. Now, that calculation conceivably could allow an SSTB, and in fact, there is a very strained example in the Joint Committee report, Joint Committee on Taxation's report on this proposal, that actually gets you to a point where you were at $100,000 above the threshold amount where you would have been zero for your SSTB, but you still end up with like an $83,000 deduction. I will say it's strained because it's a crazy example where they're $100,000 above on the taxable side, but their qualified business income was $700,000. Unless you're generous with charitable contributions, it's really tough to figure out how we get to that point. On the QBI computation, I guess it could be with NOLs could do it because we take care of those, but then if there's an NOL, there's probably a carryover negative QBI, and yeah, we got all kinds of ways it might work. But in most cases, I'm not sure it's going to be a benefit to the SSTB, right? But again, you just take the higher of the two. So if you're an SSTB, you're only going to need to do step 2. The 75% of your excess is what you lose. So if your normally computed 199 Cap A deduction is, less than 75% of that excess, you lost it. It's gone from there on. Okay? So the idea is, like we said, you take the greater of the two options, step 1, step 2, and these thresholds amounts for the two-step limitations will be indexed for inflation beginning in 2026. And we also add a special additional type of dividend to the QBI. It includes certain interest dividends from qualified business development companies. So get into that, but you'll find a new thing being a 199 Cap A qualified dividend. It won't just be REITs anymore. So that's also in play. Now, they do make it clear, yeah, there can be some of this. The exclusion, in essence, 199 C4 is amended to exclude the amounts for which a deduction is allowed under the new Section 224, which relates to a deduction from income above the line for qualified tips. That was the whole thing. We're not going to tax tips. There is a provision we're not going to talk about today, except to mention here, that would have that. You have to take that off before you compute the QBI. If, let's say, you are an Uber driver and you're getting tips, right? Well, you're not going to pay tax on the tips. You can't include them in computing your 199 Cap A. The effective dates is a permanent extension. The permanent extension, the increase of 23% modified tax, increase 23% as a rate. The modified taxable income limits, the two-step rule, the inflation adjustment, and the inclusion of BDC dividends all take effect in 26. However, the exclusion of tips from the QBI, that takes effect for basically for years beginning after 24, right? So 26 for most of this. 25, you'll start the tip exclusion because that does start this year if you go to that part of the bill. Okay? So basically for future planning, if this passes, the QBI deduction will be permanent. No longer worry about it disappearing. It'll go to 23%. You have to remember, once you get above the threshold amount next year, totally different world for computing what your deduction will be. So you have to say that, step 1 applies to immediately everybody. The W-2 limits go in full. There is no slow ramp up for that. It's going to immediately apply. So if your client, and so that sets up kind of a cliff situation. But again, if you're not an SSTB, you will have the option, you're an SSTB, you have the option for number 2. So remember, you always have the option under number 2, the 75% rule. So again, it's different. I would suggest if it appears this is going to become the law And we don't know at this point. Please keep that in mind. This is not the law. There are a lot of steps left to go. And one of them went kind of bad today, right? It went the wrong way today. That's not fatal to it. But I'm sure the Speaker of the House would prefer to have gone this way today. Phrase it that way. So we'll be there. But you do want to kind of take a look at this and, try to figure out where you're going, and figure out how it's going to impact things, right? SSTBs are now subject to that totally different limitation. It's a straight 75% over. Keep that in mind. It'll be very different. They both will, actually. These can restructure the calculation for those above the income threshold, especially as specialized service trade or business. You got to analyze the two-step calculation and figure out if this is a negative for your client, which I'm really suspecting in most cases it will be, or if it's a positive, which it can be in some cases. So you got an option either way. Qualified tip income, remember that exclusion, that will be one change that would take effect for returns for this year. If tips are excluded from income, they're going to be excluded from the QBI calculation. That's basically how it works. Again, so you need to do a lot of planning. If you have somebody like an Uber driver who operates a business, where they are getting tips, remember you got to take the tips into account for this year if you're excluding them, and they don't, if they qualify for the exclusion, which has a whole other set of qualification requirements, including an income limit, and then for 26 and beyond for the bigger changes to this provision. Now, another big change is Congress has noticed that states passed pass-through entity taxes. And we are going to change the federal treatment of pass-through entity taxes under the one big, beautiful bill, assuming it passes as currently structured. Right? So keep that in mind. Reminder again, it has not passed yet. This is going to make some real major changes. And in fact, as I mentioned earlier, essentially just an hour before I started recording this, I got an email from the AICPA that is urging me to write my congressperson and my senators, to get them to get this out, basically to either get this out of the bill or at least change how it affects specified service trades or businesses, the SSDBs. Okay. So this is a change for state and local taxes with some very specific impacts on partnerships, S corporations, and their owners related to the state pass-through entity taxes. It would be effective next year. So it wouldn't affect your 25 PTETs, affect 26 and later. Now, reminder, a number of states have their state PTET expiring at the end of this year. They would have to re-up it for the future. So if it applies, and there will still be a reason to have one, but it won't be nearly as beneficial. And it won't be beneficial at all if you're a specified service trade or business. Just phrase it that way to begin with. And again, this was approved as part of the bill approved by the Ways and Means Committee on May 14th, rolled now into the big reconciliation bill, which failed its first budget committee vote today. So that's where we stand with that. So under the current law, the prior law for this standpoint, for this bill, individual itemized deductions for state and local taxes are capped at $10,000 and $5,000 for married filing separate. It applies to income, sales, and non-business property taxes. Now, many states enacted pass-through entity tax regimes that allowed partnerships and S corporations to elect to pay an entity-level tax. This was, well, they tried it first, and arguments that it worked. In 2020, the IRS issued Notice 2020-75, and this announced entity-level PTE tax payments would be deductible by the entity in computing non-separately stated income or loss. And we've had that now, right? So your partnership elects to pay the pass-through entity tax at the state level. They pay a tax based on the income flowing through. That's considered to be a tax at the partnership level, so it reduces your line one income on the K1, which means it just all ends up on Schedule E, reduces it, and never makes it to Schedule A, which has two really good results. Number one, it's not subject to the $10,000 limitation. It's not considered income taxes on the individual. It's a tax on the business. And number two, because it doesn't show up as a deduction of taxes on Schedule A for these taxes, even though the credit wipes it out, credit or exclusion wipes out the taxes you pay, basically takes care of those for you. Because it's not down there, it doesn't run the risk of running afoul of the alternative minimum tax. So there are a couple of good things about it. So this allowed the PT owners to bypass the SALT cap by converting a capped individual deduction into an uncapped entity level tax payment, right? That they got to offset against their income. So world was great. It's going to get less great in 26. Not, like I said, there's still some benefit, but not nearly what there was. Well, now the first thing, which this is also a issue that is not bothering the people that vote against this bill in the Budget Committee, but definitely may cause problems at a floor vote with what the group called the SALT Caucus. The proposed legislation will remove the 10,000 and 5,000 limitation, but it'll put in a new permanent limitation. They will move it to 275 in the code. Okay, so they're going to move where it's at. And it will be denied, we're going to be permanently denied deduction for disallowed foreign real property taxes. There are those that are not a business or 212 related. So if paying, let's say, you have a vacation home in Italy. You're paying property taxes there to the government in Italy. Those are permanently non-deductible. Even if your total taxes are below 10 grand, my guess is most people, who have a vacation home in Italy probably have taxes in excess of 10 grand state local level, even if they live in Texas, because property taxes, we're going to assume they probably have a place here. And if you're going to have a vacation home in Italy, I'm going to assume that there's a better than average chance that your property, that you're not living in a, in a studio condo in Texas. We'll just kind of go there. Now, the individual deduction for the aggregate of these specified taxes, that's what we're going to call the new group that are limited, be limited to 15,000 if you're married filing separate and 30,000 for everybody else. So essentially, we're getting a tripling of the amount. However, that is subject to a phase down based on modified adjusted gross income that eventually, if your income gets high enough, will take it back down to the 5,000, 10,000 limitation. The SALT caucus members are stating, no way, right? We're not voting for the bill with this as limit. Now, the key question in all of this is going to be, are they bluffing? Are they not bluffing? And if they're not bluffing, how much higher is enough to buy off at least enough of them to get it through? And then your other concern there is, if by doing that, are you going to cause problems with the basically the deficit hawks, which are the people right now that are very upset about what's going on with with the spending number, and they're the ones in the Budget Committee. And let's not forget, we got a third group here that's not got anything tax related, right? But is looking at the reductions in Medicaid, and they don't want those to happen. So, yeah. And by the way, the deficit hawks are insisting those get accelerated at least, what they're going to do with Medicaid. And that could set up a real fight, because reportedly there are a number of individuals on the now, it's not really a Medicaid caucus, I know, but at least who are involved in that, who have stated that if it stays as it is, they won't vote for the bill. They're looking for fewer cuts to Medicaid. So it's like, yeah, this is going to be messy for a while. And again, it all depends on basically congressional leadership having to figure out if there is a deal, a doable here. We'll see if there is. There's a lot of moving pieces here, and a lot does depend on, is somebody bluffing? Or are they going to go through with it? Are they willing to tank the bill? Ultimately is the question. Are you willing to throw the whole thing out and say, well, then you don't get anything? Rather than, we're not going to vote for it unless you fix our problem. And there is an argument that, those three groups could all say, well, if you really feel strongly about their position, yeah, you're better off if the bill's tanked. Deficits would be lower, right? Obviously, because it'd be a major tax increase, but deficit would be lower. We would have full deduction for state and local taxes back again, and Medicaid wouldn't change. So now, the key part is probably at least a few people in this mix are bluffing, but the key is figuring out who they are and how far you need to go. Or if it's just simply not possible, and guess what? The Senate would be proven right. Yeah, we're going to say the one big, beautiful bill was doomed to fail. Generally, the Senate was not in favor of doing one bill. They were in favor of doing multiple bills, right? To do two bills and put the easy stuff in this one we're doing first and put the taxes, which are part of the hard stuff, in the second bill. So we'll see. But the two-bill option is not necessarily off the table. The Senate has not been doing much about this whole process. They're waiting to see if the House actually can do a darn thing. Now, there is an impactful change for pass-through entities, which is we are going to go to separately stating the taxes that they pay on a PTE, and they cannot take a deduction at the entity level. We are going to go from under Notice 2020-75 saying this is part of non-separately stated income, and you cannot separately state it, to requiring it to be separately stated, right? Modified Section 702A lists that partners must separately take into account items taken into account, including foreign income taxes, U.S. possession income taxes, specified taxes, and disallowed foreign property taxes. All of those be passed out separately. And modified Section 703A2 denies the partnership itself a deduction for those items. It will not be, so it will no longer be a non-separately stated item, but will be a separately stated item. Now, these rules apply to S corporations via cross-references in Section 1366A1 and 1363B2. That's how we get over there. The Joint Committee report says flat out, Notice 2020-75 is blown away by this change. Utterly doesn't apply. So, since now your entity level pass-through entity tax, if it's a specified tax, which it almost certainly will be, is no longer deductible by the entity. It's going to flow through as a separately stated item. And unless they meet a special exception, we're going to talk about here in a second, the 75% rule, these items are subject to the $15,000 or $30,000 limitation on deductions for state and local taxes for the owners. It's just going to be considered effectively their own personal income taxes. The feds are going to say, yeah, this is just a substitute for personal income taxes, so the limit applies. Okay. Now, specified taxes is key. This is what's subject to the CAT. Specified tax includes state, local, and foreign property taxes with exceptions. Property taxes paid by a PTE are specified taxes and subject to the $15,000, $30,000 cap unless they relate to the trade or business of the entity. And state, local income, war profits, excess profit, or sales taxes are this, but there is a 75% gross receipts exception for income and sales taxes only. Will not apply to any property taxes that are paid that don't directly relate to the trade or business. Income or sales taxes paid by a PTE on income from a qualified trade or business. Now, remember, I told you before, SSTBs are not a qualified trade or business under Section 199 Cap AD1. Important to notice that, right? Right. But if you have a qualified trade or business, if at least 70% of the gross receipts of all trade or businesses under common control are from a qualified trade or business, then this part of the taxes, basically state and local income taxes and sales taxes are not specified taxes. Right? They'll get out of here. Now, as I said, SSTBs are not qualified trade or businesses, so for them, every dollar of an income or sales tax that a PTE is paying will be considered a specified tax and subject to the $15,000 or $30,000 limitation, or as their income gets higher, potentially just the $10,000, $5,000 we have now. Now, if the PT pays income or sales tax on a qualified business and meets 10% tax, the tax must be separately stated. The entity doesn't get a deduction, but on the individual return, it is not subject to the $15,000, $30,000 cap. However, it does appear to be an itemized deduction, meaning that it would still be at risk of AMT causing problems for it. So keep that in mind. If the PTE pays income or sales tax on non-qualified income, like an SSTB, or fails the 75% test, that tax is a specified tax, separately stated, the entity deduction is denied, and at the individual level, it would be subject to the $15,000, $30,000 cap. Now remember, if the partner is a corporation, a C Corp, they're, in essence, it doesn't matter. They should still get, they arguably, we would hope under regulations, would be allowed to take the deduction. But then generally, C Corps don't pay this thing. We don't allow C Corps to take it. Most states are going to kind of block it there. Okay. There is also a special additional allocation mismatch tax that's added to the code. 6659 is the SALT allocation mismatch. It is a new addition to tax for situations where a partnership receives a state tax benefit, a credit from a partnership's specified tax payment, but the federal deduction for that payment is disproportionately allocated away from that partner. Let's say to a corporation not subject to the SALT cap. This deals with the quirks we have, right? Especially for S corporations, where we got to allocate this evenly, but it is possible under various state elections that some part, let's say some S shareholders might opt out, and they wouldn't get the state credit, so you get an excess credit, but the deduction, because of the per share per day rule, right, would be allocated evenly. So this would apply in cases like that, right? If a taxpayer gets a state tax benefit greater than the taxpayer's federally distributed share of the specified tax deduction, tax applies. The addition to tax is the highest rate under Section 1, so 37%, times the aggregate mismatch account. A simplified election, values the deduction benefit at 15%. So, you can kind of take a look at that and see how it goes. Now, PTEs, because of this, will have to make additional reporting. They have to report where they had gross receipts from SSTB on their return, and that'll be for K1s for years beginning after 2025 on the returns and their K1s. Both will be there. These changes generally take effect to notice, for taxable years after December 31st, 2025, right? And notice 2075 is effectively dead. Doesn't matter. PTE income or sales taxes may be deductible at the owner level, but usually it's going to be subject to a $30,000 cap unless the 75% test is met. Property taxes paid by the PTE not related to a trade or business are going to be subject to the tax. Allocation mismatches can trigger the penalties. And so you have to reevaluate the PTE tax elections and entity structures for 2026. Okay, finally, we're going to go back to a case, and this was a 50-page opinion on a complex setup, a tax shelter. It was related to interest, deductions, and penalties are involved here in this complex transaction. This is a case of Stephen v. Commissioner, Tax Court Memo 2025-45, May 15, 2025. Okay. Now, the fundamental question at odds here was the tax shelter involved promissory notes issued as part of a complex Bermuda call option agreement. Did they constitute true indebtedness under Section 163? And was the taxpayer liable for accuracy related and excessive refund penalties? The key thing that this case is going to hold is a debt must have general economic substance and risk for the interest to be deductible. Discover this one, ruled by the court, didn't. And reliance on professional advice is not reasonable if the transaction is too good to be true or the reliance is questionable. And the court had problems with both in this case. So let's talk about this. Taxpayer looking for a tax shelter. Can't imagine why that would happen, but they do. Now, the taxpayers owned SLS, which was an S corporation that had substantial income from selling assets, right? It's there. To offset that tax, they used a transaction designed by a consultant, right? Promoter of a tax shelter. This transaction involved an issuer, Hedge Red, a specially organized LLC for this purpose, lending a large sum, $99 million in 2014, to SLS, who simultaneously used the proceeds, sent it back to Hedge Red, right, to buy an option from the issuer. Exercising the option entitled the investor to a payment equal to the loan balance. So you can see where we're going here, right? We paid $99 million. We have a $99 million loan. We have that loan on the books that we're going to claim, we're going to have interest charged against. We have an option, though, that if we exercise it, will kill the loan. But it doesn't even stop there, right? We got more things. The loan, notes in 2014 and 16, was non-recourse to the lender, Hedge Red, that LLC that was set up for this transaction, except for their security interest in the call option itself. They had no recourse against any other asset. Are you beginning to see why the IRS might have felt there was no loan here, right? A separate cash payments by SLS, $609,000, funded an interest rate cap component of the option. A tax opinion was obtained, but here's what happened. I don't go into details in the written part of it, but they were told they wanted to get a tax opinion letter. They were told by the promoter that they could go to this attorney, who he pointed them toward, and for $10,000, he would tell them all of this was good. Well, they went to the attorney, and the attorney balked and said, I'm not doing this for 10 grand. Right? So there was some back and forth. Things went on. Eventually, the attorney agreed to do the letter for 40 grand. Now, we don't have any idea about the backstory in all of this. But it seems at least plausible that the attorney had been doing these, was getting skeptical of them, right? Or was beginning to get concerned that he had exposure, may have finally been told by somebody, you got exposure on this if things go bad. And so he was going to back out. He felt that 10 grand was not adequate compensation for the risks he was taking. And maybe he just really didn't want to do it at all. I think we're beginning to get that feeling almost too. So he started raising the price. Okay, eventually the promoter got on the line with him and eventually pressured him and got it to $40,000, and he would issue the letter. So he issued a letter to the taxpayers in this case, stating that, that this would be a valid loan under federal tax law. The interest would lead to valid deductions under federal tax law. The interest component of the loan would lead to valid deductions, and these would not be small deductions. Right? Now, what happened, though, was the taxpayers went to their CPA to get their return prepared for the year and to claim this huge deduction. The CPA said, guys, I think we need to disclose this. Now, obviously, as you might guess, clients aren't thrilled about doing disclosures on things like this. We just bought a tax shelter, and you want us to tell the IRS openly that we bought a tax shelter. Didn't tell us all disclosures, but even conceivably, I would assume this might have been viewed to be a basically at least a reportable transaction, if not a listed transaction. So there could have been all kinds of reporting to flag it. So the taxpayers were concerned and said, okay, they asked their attorney for his position. Now, their attorney, who got this whole thing dumped on him now, he contacted the attorney that gave the opinion letter, apparently skeptical, right? So he talked to that attorney, right? And the attorney is Rubinger. If you look at the slide, that's where Rubinger comes in. And during the phone conversations back and forth, eventually Rubinger said, well, he would actually advise the client against, he would advise against claiming the deduction if it was his client. Basically, that's what he kind of said. And, the attorney says they are your client. The other attorney says they are your client. They're my client, right? And Rubinger said, well, yeah, I'd advise against it, but don't tell them I said that. Not surprisingly, the client's original attorney said, I'm not going to do that. I have an obligation to inform them that you just told me that, in essence, even though your letter says it's obviously a clearly allowed deduction, that you're saying you wouldn't take it, which suggests you don't believe the letter. By the way, that's how the court's going to read it, too. So he told the clients. And the clients, even with that fact in hand, went ahead and claimed the deductions on their return. And we aren't talking about small deductions. It was approximately $6.1 million for 2014, $20.2 million for 2015, and $7.8 million for 2016. And the 2015 big deduction created an NOL that was carried back to 13 that got a refund. So now we have all of these years in play. Right? The IRS examined all of this, and the IRS came back and disallowed them all, saying there is no loan here, there is no interest being paid, this thing is a total farce. Right? So all of it's gone and threw penalties at it. So let's get to essentially two core questions. Did these notes, and by the way, there was a new set of notes in 16 that were issued when the first was going to come due. So we had a pair of notes. Were these notes true indebtedness under 163? Because if they're not actual indebtedness, you could not deduct interest, right? They were deducting the accrued interest on these notes, but the court is saying essentially you can't deduct the interest on these notes, or the IRS is saying, and the courts have said before, if it's determined this isn't a real debt, there's no interest, right? And core issue 2, assuming they lose on core issue 1, are they liable for actually related penalties under 6062 and excessive refund penalty under 6676A? Because remember, they requested a refund from basically from, in this case, in 2013, right? The year they carried back to. I always forget where they carry. I got to remember the history there. They had that excessive refund. Now, the IRS disallowed deductions, and I mean, there are huge deficiencies now because you saw how big the deductions were going to be. They had a lot of income. And they also asserted penalties. They inserted the 20% accuracy-related penalty for negligence for 2014, 15, and 16, and they asserted the penalty for an improper and excessive refund claim for 2013 under 6676A. Now, the taxpayers challenged the penalties on the merits. They claimed they had reasonable cause, good faith reliance on tax advice, and they argued procedurally that the IRS hadn't obtained proper or timely supervisor approval under Section 7651B. So let's take a look at the debt question, which is a key first one. Okay, they looked at the note and option. Now, the court agreed that SLS would never pay off the note except through an offset against the option. Didn't matter how things turned out. They said that was a mirror image of the note, and however you moved into the future, it always was no money would change hands. The option would be exercised. It would all wash out against each other, and we'd be done. Okay. So they said, here's a settlement. First, it could be physical settlement. The option agreement structure was so the note balance and settlement date exactly equaled the predetermined option value component minus the strike price. HedgeRed's only asset for that repayment it could claim was the note itself. Right? HedgeRed would take the payment by releasing the note. Make the payment. Right? That's how they would do that. The calculations showed the cash payment for the predetermined component would be essentially zero. As the note balance, the holder debt was netted out. Cash settlement explicitly states any such debt associated with the call, meaning the notice was satisfied, SLS would make no separate payment. As they had said, make the payment, actually get the payment by doing that. And if the option expired valueless, the note maturing later was uncollectible, as HedgeRed's only recourse was to the option. So if the option is worthless, they're not going to get repaid. So the court said, no matter which thing happened, we're going to assume the parties realize what's in their best interest, and there's never going to be anything but an exchange of, we're going to exchange these two and wipe them out. There is no scenario under which that loan would actually ever be repaid, that interest ever repaid, and SLS would be out of pocket for this interest. It simply wasn't going to happen. Okay. So regardless of exercise or expiration, the 2016 note would eventually disappear, having no effect. The lack of a genuine obligation, that's what they're saying here, means it was not true indebtedness under 163, and they cite Catch and BB&T Corp principles from those cases for backing that up. Now, they rejected the petitioner's arguments. The court found they found this duration gap scenario, which you'll read about if you look at this. It's a very messy thing, was non-existent because it was limited upon exercise. The lack of a hedge fund risk compensation and absence in documentation undermined totally that argument. Remember, we had this all set up to offset. It also did not meet the analogy to a Formosa bond. It failed because a true loan involved usable fund. Here, the note proceeds could only buy the option eliminating the note. Cancellation was not inevitable in the Formosa bond situation they mentioned, but effectively it was if this note was exercised. It just was there. And while the interest rate cap, while potentially valuable, it was paid for with cash, not the note proceeds. Note financed only the predetermined option payment right to offset the note itself. Did not make that note true debt. Okay. So, having held that they owe a ton of tax, do they also get penalized? Well, for negligence under 6062B1, the court found the IRS met its burden. The taxpayers knew that Rubinger, the attorney that wrote their letter they claimed to relied upon, had advised against claiming deduction. They claimed them anyway. The significant benefits they received versus a small economic cost, which was $890,000, $930,000 for the years in question, meant the benefits were simply too good to be true. We assume you're not idiots. We assume that you should have realized that paying, essentially less than $2 million should not allow you to claim deductions into the tens of millions of dollars. For reasonable cause or good faith, they failed their burden. They solicited their opinion solely for penalty protection. They didn't care about the proper tax treatment. Remember, for good faith to apply, the taxpayer must have attempted to determine their proper tax obligation and have failed to be able to determine that due to conditions outside their control. They knew, they're claiming that they had this, opinion. I have a letter, right? I have this letter. They're saying you knew that the author of the letter didn't believe it. You knew the author of the letter's advice was the thing you should do to properly report your taxes was to not report the interest as a deduction. Because your attorney got him to say that and told you it. You were aware of that, and yet you still kept it. That indicates you were opinion shopping. You were looking for somebody who would say it worked. And when you later discovered the inconvenient truth that he was now saying it didn't, you decided, well, that's not in the letter, so we have our letters, so we're good. It's like, we're not going to let you do that. The true good to be true, even with the letter, even if Rubinger hadn't, basically said, hadn't basically conceded that he would not recommend deducting it, that too good to be true would also have been a problem. And frankly, a third issue that the court didn't even raise, but this probably gets really close to relying upon an opinion letter from counsel that is essentially, being recommended. You're using the counsel that specifically is being directly referred to by the promoter. And the courts think, look, this guy is getting this fee. He's getting the fee for doing these letters, and he knows if he ever does a letter that says it doesn't work, he will no longer get these referrals. So there's an inherent bias there that you should have been able to see, because you didn't go to your attorney to find this question. Remember when push came to shove, they actually went to their normal attorney, who clearly was skeptical. Yeah, you didn't go there because you thought he'd probably tell you no. So you opinion shop. That's never going to be reasonable cause and good faith. There is no reasonable cause for your refund claim because of all these other things. You knew the advice was against deductions. The gross disparity between the benefits you were getting and what you had paid was wildly evident. No way that works. And, it does take a genius to see that that's not a real note, right? And the court did find that the IRS met its burden, applying the Ninth Circuit lay law decision, which is controlling under the Golson rule. The Ninth Circuit has issued this decision. Approval is timely if before notice of deficiency was issued. The approval was obtained before notice of deficiency was mailed was timely. Right? There's different rules in different circuits. You've got to watch that right now. We don't have a standard rule. Okay? So key takeaways from the case. Notes have got to have economic substance and risk of repayments beyond offsetting components of the same transaction. If there's no actual risk going on, there's never going to be a true repayment. Nothing's really happening. Are borrowed funds actually usable by the borrower? Is there going to be an actual repayment? In this case, neither of those was true, right? It's there. Your clients have to understand if it's too good to be true. That gives you on a heightened level of having to be very, very careful about claiming those benefits. Yes, there are some things that a client might think, when you're in tax, there are some things where Congress grants benefits that sometimes are, kind of seem out of line. But the catch is, it's not that those things can't exist, but it suddenly puts you on, you should be very skeptical, and you really, 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 really want to find truly independent, counsel that will look at it, you're going to pay regardless of whether they say yes or no, right? They have you're their only client. They're not doing this for the promoter. They're not being recommended by the promoter. They are simply your attorney or your CPA, and they're just doing it for you. And you've agreed to pay them regardless. It's not contingent upon them giving the right answer, right? That'll be key. And deficiency cases in the Ninth Circuit, supervisor approval under 6751B is timely if it's obtained before the notice of deficiency is issued. There are other rules in other circuits. I will warn you ahead of time, so don't hold that outside the Ninth. This has been the Current Federal Tax Developments for May the 19th, 2025. Current Federal Tax Developments, as always, are brought to you by your state side of CPAs. I'm Ed Zollers. I'm located back here in Phoenix. We're going to keep our eye on whether we actually have a tax bill moving in the near future, if it's stalled, or if it totally implodes and we just had the equivalent of, basically repeal and replace Part 2. And the Senate, they're saying, we told you so. Or we see if we switch over to a two-bill strategy. We're going to keep our eye on all of that right now, because right now we don't know what's happening. As of the moment, I'm just saying I don't think the speaker is currently celebrating, but I also think it's not totally surprising. He should not be totally surprised he's at this point. Right? It wasn't like he thought it was a slam dunk. It was going through this afternoon. So that'll be interesting to watch. If you have questions, you can email me at zollers@currentfederaltaxdevelopments.com. Right. I also pay attention to connect groups for the Arizona Society of CPAs, New Jersey Society of CPAs, the Idaho Society of CPAs, Minnesota Society, Illinois, and Washington. So if you have questions, you can kind of look in there. Otherwise, we are going to see what happens in the next week in taxes, see what goes on. Like I said, keep our eye on the tax bills for now. And I've got to keep my eye really close on it, because I'm supposed to do an update at the New Jersey Society's convention coming up in early June about where we stand on bills. And right now it's like I have no idea where we stand on bills. So this is becoming kind of fun. But in any event, I will see you all next week, and we'll talk more about current federal tax developments.